Well, welcome into a daily editorial here on the KE Report. I am chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. And Jordan, there's not too much to talk about in terms of the resource sector. Yes, we got a nice little bounce at the beginning of this week in gold and in GDX, but we're not breaking out by any means. We're, again, just maintaining in kind of the middle of this range that we have been trading in. One thing that I do want to talk to you about, though, and it's something you and I have talked about time and time again, and that is when a rate cut happens, that will be very beneficial. It will be huge for the resource sector. But until that rate cut happens, I think we're all kind of waiting for potentially the next financial crisis to hit. But then the question is, last time the financial crisis hit, we saw more or less everything get sold off. Even gold, the precious metals, the miners, they got sold off, and they did rebound quickly, but there was a bit of a devastating washout in the sector. What about this time? If we get another global financial crisis, is the outcome going to be different?
Well, the outcome of the crisis definitely will be different because if you look at the structure of the economy, you don't have a repeat of the same crisis. And the reason for that is because after the first crisis, it forces certain industries and companies to change their ways and be in better condition to be able to get through the next crisis. And more simply, when you have like a banking crisis, like we had the last time around, and you have a housing crisis, that affects everything in the economy because, banks are really the heartbeat of the economy. They, pump out money to the rest of the economy. And so banks are obviously extremely important. And banks have delevered. They've been recapitalized, at least in the U.S. So they're in much better shape. They're better able to withstand the next downturn. And you can also say that about the housing market. Now, I think if we're looking at, where's the real issue, where is the debt, where are the trouble spots for the next downturn, they're likely to be mostly in the corporate debt market. But even with that being said, if you look at the shape of the corporate debt market, the top 10 or 20% of companies are in really strong financial shape. However, if you were to look at like the bottom 70 or 80%, those are in not that great of shape. They've taken on a lot of debt, so higher rates could really hurt them and wreak havoc. So that would obviously be negative for the stock market. I don't think we're setting up to have another 50% downturn. But, you could get maybe a 30, 35% bear market next time around. And the problem is also with government debt, Corey, as we all know. And if you look at households, it's really not, it's clearly not going, I shouldn't say it's not going to be a problem because a downturn, of course, is bad for everyone and everything. However, if you just compare it to where households were in 2008, they've delevered a great deal. So I don't see, I think people who are saying we're going to get this repeat of 2008, they're really, not really looking at this closely enough. They're missing the big picture. And with respect to precious metals, Corey, if you look at history, what matters is the negative correlation between precious metals and the stock market. And when the two are negatively correlated, like they have been in a very long-term sense since 2011, and there is a downturn in the economy and financial markets, that tends to be really, really bullish for precious metals. So, this is not a repeat of 2008 where precious metals have not been, remember, precious metals were rising with the stock market for several years into that event, and that's why they both sold off together. But going into the next downturn, we have the complete opposite situation where the stock market has been on a tear for years and years, and precious metals, I know technically they bottomed at the end of 2015 or early 2016, but since that pop in 2016, they've been trending sideways to lower. So they have not been, they've been hurt by the continued bull market in U.S. stocks, and therefore, when we get the next downturn, it's going to be very bullish for precious metals because, as we know, the Fed will step in. They're going to cut rates aggressively. try and figure out other ways to, pump money into the economy. And, as we've talked about, Corey, over the last year or so, cutting rates, when that happens, that's going to start the big move higher in precious metals.
All right, one other kind of topic regarding the next, say, great financial crisis or whatever pullback we get in these markets comes to that term of that destruction of capital. And that's what happens when you have a lot of loans go bad, people can't pay back loans, and this money just kind of disappears. Do you see that same risk happening with some of these corporations that hold these massive debts that they either have just been buying back their shares or taking on debt just to keep the ball rolling? Is that kind of where the destruction of capital will happen rather than happening to the average citizen who held too many mortgages, say, in the last crisis?
Yeah, that's a great point, and I completely agree with that. And, I haven't looked at the corporate debt situation that closely, and I'm not an expert on that by any means. So yeah, I mean, that could be, and I'm not trying to be too, optimistic about the next downturn, because that could, that could be something that's very serious. And, I don't know, maybe it'll lead to a 40% bear market, but given how banks are in a better spot, and given that the picture of the debt, it's really like the bottom 70 or 80% that are really in trouble. And these indexes are capitalized in a way where the largest companies make up such a large share of the market. So if the top 10 or 20% of these companies are very healthy, yet the bottom 70 or 80% are in really bad shape, it could be a really bad situation because of the structure of these indexes. Maybe it's only a 30% downturn when it feels like a 40% downturn. But I don't mean to get too off the question, but I just don't see it being that big of an issue for citizens and households, because look, they've delevered so much after the last crisis. Whereas if you look at, where has debt been increasing the most? It's government debt, and that tends to be inflationary after a downturn, and also with the bottom 70 or 80% of corporations.
All right. So, Jordan, I guess one other comment regarding the rate cut is that I think we both agree that we're just waiting for a more significant market pullback before the Fed does cut rates. Do you have a general idea of maybe how long the Fed could wait? How big of a maybe percentage-wise pullback that could take for the Fed to finally start cutting? Or are we even waiting for that pullback to happen? Is there something else that you think could cause the Fed to start cutting?
Well, those are excellent questions, Corey. I think if we're looking at the Fed funds futures, I haven't checked them today, but looking at them yesterday and the day before, I believe they showed about over a 70% chance. I think it was 73% chance of a rate cut this year. So a 73% chance of a rate cut by December. And I think by September, the market showed a 51% chance, or it was priced in by 51% that you could get a cut by September. So I think I'd really look at September and December as the key meetings for when a cut could happen. Obviously, Corey, a lot depends on the stock market. You don't tend to have a lot of triple tops in the stock market. So if you're looking at the S&P, it's made a triple top. However, if you put a gun to my head and said, is this going to break out, or has it peaked, or we're going to have a bear market? I think it's more likely than not that after the market corrects and consolidates for a few months, it's probably going to break out. However, who knows? It could be a false breakout. But if the market does break out sooner rather than later, that's something that could possibly keep the Fed on hold. However, this tariff stuff is really an issue, because if you look at the tariffs that have already been enacted, according to what analysts are saying, that is probably going to add, roughly 0.5% to inflation, give or take some. And obviously that's going to hurt growth. So the tariffs are stagflationary, and that's very good for precious metals, because higher inflation and hurting economic growth, assuming that would move the Fed to cut, that equates to a sharp decline in real interest rates, and that's very bullish for precious metals. So we have to continue to watch the tariff situation. If that continues to escalate, I think that could push the Fed to cut sooner rather than later. However, you never know what's going to happen. Maybe the White House will come out and tweet something about, we're going to make a deal or we're going to stop this and rescind the tariffs for now. I mean, that could come out at any point. And if, that comes to pass and the market is able to go to a new high, then that's probably going to keep the Fed on hold. So it's not abundantly clear or obvious that the Fed is definitely going to hike because there's these moving parts that can really change at any moment. So with that said, Corey, I think that's a big reason why precious metals are struggling to gain traction. I mean, we did have the nice move in gold a couple days ago, but it gave some of it back yesterday. The move in gold was not confirmed by the move in gold stocks or silver. They're both way too weak. They both should be trading much higher given where gold is. And you don't want to be too bearish on precious metals here, given that we're seeing a lot of value, especially in the juniors. However, again, you don't want to be too bearish because if this tariff situation escalates, then that could lead to a cut sooner than we all think. So there's a lot of moving parts here, Corey. But the key for precious metals is, as we've talked about, it's really going to be when the rate cut happens. If I looked at the last couple cuts and the strong outperformance in precious metals in nominal performance, it happened as soon as they cut. It didn't happen 2 or 3 or 4 months before. It happened when they cut and then after they cut. So the cut is the key for precious metals.
Yeah. Hey, I agree with you. It's something that you and I have talked about, but again, this is a process and there are a few more things that have to happen for that rate cut to happen, or really to force the Fed into a rate cut scenario. And that is why the precious metals prices are kind of stuck in this range. There's some obvious positive drivers, but right now there are also some drivers that are holding people back from going all in on the precious metals, or even for that matter, taking a more significant portion of their portfolio into the precious metals. Overall, though, Jordan, some interesting comments on what the next recession or crisis in the markets will look like, and maybe why this time it will not pull down the precious metals like it did last time, with why all the debt was kind of spread out in a few more consumer-focused areas. Jordan, good chatting with you. Everyone, click that link below. Go visit Jordan's website and follow along with his commentary on the metals sector. Jordan, thanks for your time.